Welcome to CPE Voices, our series through which we present insightful discussions among industry thought leaders, moderated by our editorial team. Today, we'll be discussing our outlook for the rest of the year and into next year. I'm Suzann Silverman, Editorial Director of Commercial Property Executive, and I'm here today with a group of knowledgeable experts ready to take the pulse of the economy and the commercial real estate market. They include Mark Zandi, Chief Economist at Moody's, Lisa Pendergast, President and CEO of CREFC, John Chang, Senior Vice President and Chief Intelligence and Analytics Officer at Marcus & Millichap, Matthew Chatham, President of Occupier Advisory Services at Cushman Wakefield, and Scott Crowe, Chief Strategy Officer and Head of Equity Capital Markets at RXR. We're recording this session, and it'll be available for later viewing. In addition, we're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar. And thanks to those of you who submitted some in advance. We'll try to get to as many as possible. Mark's going to start us off with an economic overview, and then we'll get into our discussion. Mark, I'll hand things over to you.
Thanks, Suzann. It's good to be with you. Thanks for the opportunity. Let me preface things by saying the obvious. There's a high degree of uncertainty in terms of the economic outlook. There always is, but it feels like it's especially high in large part because of the uncertainty created by economic policy and also artificial intelligence. AI has come on very strongly, very quickly, and can go in lots of different directions. So I'll give you my sense of things, where the economy's headed over the next 6, 12, 18 months, but just take that into consideration. So bottom line, the economy's growing. GDP growth, real GDP growth after inflation is 2%. That's what we grew last year, Q4 to Q4. You can see that in this first chart in the first column, 2025 growth. So that's in the history books. That's okay. It's tenuous growth though, because it's below the economy's so-called potential rate. The potential rate is that rate of growth consistent with enough jobs to maintain stable unemployment and participation. And the unemployment rate, while it's stabilized in the last few months, has been drifting higher over the past couple, 3 years. And participation most recently in the past years declined quite sharply. Just to give you a sense of that, if the participation rate, that's the labor force participation rate, had remained unchanged over the past year, the unemployment rate today would be closer to 5% as opposed to 4.3. So the economy's okay, but it's a tenuous kind of growth. And the fundamental reason for that, and I expect that to continue over the next 6, 12, 18 months, is that we're in the economy's in a pitched battle between various crosswinds. The headwinds created by deglobalization. You can see here in the table in 2025, deglobalization as caused by the tariffs and the restrictive immigration policy shaved almost a percentage point off of GDP growth. So what that means is, if not for those policies, the economy would have grown 3% last year, not 2%. So that's the headwind. The tailwind is obviously AI, and that is occurring through several different channels. One is through the most obvious being the capital investment, the data centers being the poster child for that, but it goes beyond that, obviously. Goes to the stock market wealth effects. The surge in equity prices has lifted the wealth of the well-to-do, and they're outspending. It's also, perhaps most importantly, most recently, resulted in an increase in business formation. So we're seeing a lot of new businesses forming, and that's very encouraging. You can see in the table that my estimate that AI last year contributed about 0.5 point to growth. Economic policy was kind of a sort of a wash. The Fed was cutting rates last year. That added a little bit of growth. We had DOGE cuts to government jobs that shaved growth. Now take a look at 2026. It's remarkably similar, a top line growth of 2%. Again, Q4 to Q4. And by the way, I'm not showing it, but in 2027, I expect about the same. Of course, the Iran war is a drag on growth, about 0.3%. If everything kind of sticks to script there, if the war continues to wind down and oil prices continue to recede here, then we'll get that 0.3, but a lot of risk around that. Deglobalization continues to be a headwind, a bit less so in terms of the tariffs. The worst of the tariff effects are behind us, assuming there's no major changes on that going forward, and that's a positive. And AI will continue to be a major source of growth, although I do expect a little less from the stock market here, but we'll see how that plays out. One key source of growth this year, at least in the early part of the year, was fiscal policy. That goes back to the One Big Beautiful Bill Act, the OBBA, tax cuts for businesses, expensing on investment, and some pretty significant bigger tax refund checks for individuals. Although that stimulus, those deficit finance tax cuts, the benefit of that are largely behind us at this point. So the net of all that, kind of a 2% of economy. So okay, I'll take it. But it's not quite what we need to maintain full employment, and it's not sustainable long run. We need to see more growth. There's obviously a lot of risk around all of it, and I just want to go to one more slide, and then I'll end my comments. I will say the risks to the outlook are more symmetric than they have been in the past. There's both upside and downside risk. I'm going to focus on the downside risks here just because I think that's most prudent, and you get a sense of that here in my risk matrix. The x-axis, the horizontal axis, is the severity of the risk. It's kind of a present value of economic loss if the risk were to occur. The y-axis, the vertical axis, is the probability of the risk, the likelihood. Obviously, it's very subjective. If the risk is in green, it's moving in the right direction. So you can see, for example, Fed independence is impaired. I'm much less worried about that after last week's FOMC meeting and the way that played out. It indicates to me that the Fed is independent and making policy based on economics and not politics. AI leads to large job loss. Obviously, it's a very significant risk still in the northeast part of the matrix, but moving in the right direction. I'm less concerned about that. And that goes back to the business formations that we're seeing and the job creation that's occurring there. That's offsetting some of the job loss that's occurring in businesses that are jobs that are being substituted out. Finally, and I won't belabor the point. We can talk about it in the Q&A. But if the risk is in red, it's moving in the wrong direction. Global pandemic obviously goes to Ebola and the fact that we're investing less in monitoring and mitigating the risk of global pandemics. Major cyber attack, that goes to Mythos. A lot to talk about there. Less concerned about the big SIFI institutions, more worried about the smaller banks and the potential for a run if a string of them were to be hacked. And then finally, Federal Reserve missteps. Obviously, the Fed's got a pretty tough job here with the high inflation and the weak growth. Very difficult to know what the right policy is, and easy to see them making a mistake here. So I'm assuming in my 2% growth world, we get no change in policy going forward through the end of 2027, but a boatload of risk around that. So, Suzann, with that, I'm going to stop. It's pretty tough for an economist to keep the 5 to 6 minutes. I did my best, but I'll throw it back to you.
That was perfect, Mark. Thank you so much. So yes, let's jump into discussion and let's talk about the impact on real estate usage and space needs first, and then we can discuss the impact on valuations and how investors and lenders are responding. So Matt, then I will go to you next and ask you, how do you see corporate occupiers behaving in this economic environment?
Well, first, Suzann, thank you for having me, and Mark, love your comments. Yeah, if you think about leasing, you really tie it back to how occupiers are thinking about their space needs. And for so long we had this return to office message that was out there that we really started to feel once the pandemic hit in 2020. But I would say over the last 18 months, the office markets have been extremely resilient. If you think about a corporation, an occupier, what they're facing right now, Mark just covered a lot of it, but they have, some volatility, whether it's with policy or tariffs or what's going on with rates, and certainly this transformational technology that is upon every business with AI coming in, and of course the geopolitical uncertainty that's out there. Any one of those in previous cycles would have caused some pause, but businesses, and the data shows it, are focused on their own strategies. They're focusing on how their businesses are performing, and they're making longer term commitments that are capital intensive, that are investing in their people. So I would say the office market overall, demand is improving. It's no longer retreating. Our U.S. vacancies around 20%. That continues to move down, but more importantly, occupancy. We focus more on that now. In 2022, most companies were about 20% full time back in the office. That's up to 50% now in 2025. And if you look at Class A office, where a lot of the demand we've heard a lot about flight to quality is, you're averaging in a given week at 79% levels compared to pre-COVID levels. And then on peak days, you're at 97% occupancy. So we're basically back for a couple of days a week to where we were. So if you think about actually using office, the office is important. Companies have seen that it ties back to productivity. And there's a lot of examples of where that productivity is going even beyond. Mark mentioned the AI jobs being created. Those companies are actually on a mission. Some of them are in the office 7 days a week. So we're really seeing this nice moment and this resilience, and especially in the Class A part of the market. And the data is not showing that's slowing down.
And there have been some really notable city recoveries as well. San Francisco, New York, Dallas. What's driving those recoveries, and how do you expect them to continue in the face of current geoeconomic challenges?
Yeah, it's really, if you drill down by market, certainly the ones you mentioned are driving a lot of that growth. But if you think about just U.S. markets overall, the office markets, 50 of U.S. office markets last year had positive absorption. Okay, 63 of the 91 Class A markets had positive absorption the last 4 quarters. Okay, so all these markets are really improving, but certainly Dallas, New York, San Francisco. Dallas is, Y'all Street. That's a real thing. You've had, compared to pre-COVID, you have 28% more leasing by financial services in Dallas. So financial services is growing there. There's more demand in that market. And then you have the AI phenomena in the Bay Area. Just last quarter alone, Q1 alone, you had 50% of all leasing that was done in San Francisco was done by AI companies. And then Silicon Valley, which is a much larger market, San Francisco is about 85 million feet, but Silicon Valley, across all product types, is about 300 million square feet, so the size of Manhattan almost. And of all leases done last quarter, 66% of them were done by AI. Okay, so there are major jobs being created around AI. You're seeing the growth within financial services go to Dallas. Certainly, you've seen the legal sector continue to expand. They're committing to long-term leases in major cities. And so overall, we're really seeing positive absorption in office. I think, as Mark mentioned, there's questions at any given time. Are any of these factors that are out there going to rear their head in a stronger way? But the data that we have right now and the demand we're seeing in the market leans towards office coming back in a strong way.
Okay, thanks. John, have there been any changes in office valuations as a result? And what are your expectations for the sector?
Yeah, the office sales market is very bifurcated. It's hit and miss. There's, top tier office properties are commanding a premium. Their performance is doing very well. You're seeing that in the Bay Area. You're seeing that in New York, parts of Dallas. But by the same token, there are properties that are still selling for massive discounts, and they may be facing headwinds. They're troubled assets. They may be going into foreclosure. So you really have a broad spectrum of outcomes, just depending on what you're looking at. If it's a upgraded walkable building, you're getting a top tier price. You may be looking at a, kind of a low to mid 6 cap rate on a top tier property. Whereas other properties are selling for pennies on the dollar. And so investors are getting more active in the space. They're seeing opportunity. We're seeing a positive trend, as Matt mentioned, We're seeing positive absorption running for 8 quarters now. And so the momentum has certainly shifted, but it's still slow. And there's still a very high vacancy rate depending on the property and the location. So for investors, I think there's a lot of opportunity out there, but they really need to know what they're doing. They need to have their tenants in tow and be ready to make some upgrades to the property to make it work. But we're certainly in a better place than we have been over the last few years, and the momentum has clearly shifted to the positive.
Thanks. And if anybody's got anything else to add, please jump in at any time. But Lisa, how much distress is still out there, and what are the prospects for refinancing it?
So, I mean, there's a significant delta between where some of these loans are maturing and where the current mortgage rates are. So that has become a significant impediment for many folks who have, sort of debt maturities coming due. And so to the extent that debt outstanding right now totals across all of our, various lending segments at around 6.4 trillion or so. And so it's significant. And to the extent that a lot of these loans, I think the big concern that I have, are loans that were done in the 4% kind of area that are now going somewhere to 7. And so there's a significant hurdle there for borrowers who are going to have to come out of pocket to some extent to, either pay down the loan or find a way to refinance at these current elevated rates. And it's interesting because it's difficult to see that changing significantly near term, given what the Fed is sort of out there suggesting that things stay state for some time here. And so that's a real issue. And, when you think about the number of and the maturity of just the volume, it's just significant. 875 billion in 2026 alone. That number starts to decline to the 650 kind of billion down to 5, just around 600 in 2028. So there's a heck of a lot of loans coming due. And yet, they were all done at rates that were significantly lower in 16, 17, and 18. So we do worry about that. What we've seen oftentimes is that these loans, as I mentioned, do get extended, with the thought being that over time, whatever cash flow that might have been diminished over the last couple of years is starting to rebuild, as well as, the thought that the Fed at some point moves. It doesn't suggest to me that they're going to do that anytime soon, anything significant, if anything at all. And so that whole rate environment is a real catch-22 these days in terms of how you move forward. Having said that, I do think that there are limited number. The banks are pretty much the more significant participant in terms of the number of loans that are maturing at 396 billion. CMBS, another 200. And then the REITs and the debt funds and all of that are somewhere around 163. So again, that's just this year. Those numbers do decline in 27 and 28 to the good. And hopefully at that point, we see lower mortgage rates, lower benchmark rates, such that the refinancings aren't as challenging. They don't require money in, that type of thing. And so that's something we've been dealing with now for quite some time. I will say from a lending perspective, the CMBS market and the CRE CLO market work together nicely. In my mind, the CRE CLO market is really more for transitional loans or transitional assets, and to the extent that they're feeders into, a stabilized loan or stabilized asset with a loan from a SASB deal, a conduit deal, or any of our, life cos, banks kind of lenders. So I think the liquidity is there. It just depends on the performance of the asset, and what that sort of loan is going to look like in terms of mortgage rate, in terms of loan to value. Clearly, if there's something that's somewhat suspect, you're going to want to see much lower LTVs, which just makes it difficult, though, for the owner borrower to make that work, and especially at today's elevated mortgage rates. So there are some challenges out there, although it does seem that, the market has done a nice job of trying to extend existing loans such that you kind of wait it out and hope that, at some point you see lower mortgage rates, lower cap rates, and that will allow eventually for we to kind of work those things through.
And you see lenders still being willing to kick that can down the road where they need to.
For now, I do see that it's not going to, it doesn't last forever, nor should it at some point. Waiting on the Fed at this point, it's kind of like waiting for Godot. I don't know when that's going to happen. So to the extent that, the sooner that happens, the better, but there's no indication currently that that's something that the Fed is seriously thinking about near term, which, doesn't really help the market out all that much. Even now, if you think about it, core CPI, PPI numbers do not suggest that the Fed is going to do something anytime soon.
So let's talk. We've talked a lot about office. Let's broaden that out more and talk about this commercial real estate market in general. Scott, how much impact have geopolitical and federal policy issues had, and which issues are most likely to have an impact on CRE performance in the coming months?
I think geopolitical issues have probably had a disproportionate impact on the macro generally over the last sort of 24 months. And I think, Mark put up a slide earlier that, showed some calculations of perhaps, the direct economic impact of a couple of episodes, including, the tariffs in April of last year and then the war in Iran. I think what I've seen on the ground is that, the CRE market was, sort of poised to, start getting moving again at the beginning of last year. And then when tariffs happen, it doesn't take much to get people to, to slow down. And then, I think the bigger issue really is with what's happening with the Iran conflict is the feed through to inflation. And, I think one of the big things that's changed, the flow-on effect of that is the Fed, right? I think, the mantra has been for many years that the Fed's going to cut and, ease the pressure on commercial real estate values. And I think that's off the table. Is it, we sort of, the mantra was higher for longer, and I think it just might be higher. And what I mean by that is that we're just going to be in a, this is the new normal. Higher interest rates are here to stay for the foreseeable future, because you have a few things at work. Like the Iran conflict's one thing, certainly hasn't helped. But the bigger picture is you've got, pretty aggressive fiscal spending. I think, that was also shown in Mark's slide over the foreseeable future. And then you have this huge AI spend. And the AI CapEx is just sucking all the oxygen out of the room, whether it's in an investment committee determining whether to allocate to real estate or not. Whether it's the fact that, corporate America through this, we're in the leverage stage of AI, right? Where a lot of these companies are now issuing bonds to fuel their growth. And, that means that the corporate sector of the United States is going to be the biggest bond issuer, debt issuer relative to the government, I think for the first time ever. So this is naturally just going to put, it has real world impacts in terms of the spend that we see as we go out there to bid for various, contracting services and materials. Is going to have a demand impact on the economy, and that demand impact is highly interest rate insensitive. Unfortunately, with the Fed increases interest rates 25 or 50 basis points is not going to stop these hyperscalers executing their their plans, and then you have a direct capital markets impact with this debt issuance, and so I think that these macro forces are pretty impactful as it relates to the go forward for commercial real estate.
John, what's your read on the impact of higher interest rates and the prospect of possibly more increases again on CRE performance and valuation?
Scott was spot on, and these political changes and geopolitical shifts have had a huge impact, and it's so unpredictable. And as a result, if you look back in February, everybody was baking in rate cuts. Today, we're baking in rate increases. And it's been a little bit of a whipsaw for investors. I think that there's some challenges there. And I think they're generally short term. We've seen rates go up, but that's not a huge increase. I think from the low in February, we're up about 50 basis points on our rates. And that's enough to cause people to pause. I think there will be some recalibration in the marketplace, and values may drop a little bit more as a result. And I don't see this clearing up, the rate outlook getting any better anytime soon. I'm in alignment with Scott and Mark on that. So the challenge is, how do we make these things pencil? Now, demand for the space, commercial real estate fundamentals continue to improve, although very slowly. We still have supply overhangs for industrial and apartments in some markets. We still have that overhang of office space out there. Retail's holding up pretty well in general, although we had a couple quarters of negative absorption there. But in general, the real estate market is slowly getting better. The momentum is positive, but the uncertainty continues to be a challenge. And as long as we keep getting curveballs, it makes it much more difficult to make decisions. So from the investment standpoint, people did pull back a little bit when the rates jumped up, and we see them kind of getting over that hurdle. There is still a lot of dry powder out there. Again, as Scott mentioned, a lot of these issuances from the tech firms have taken a lot of the capital off the table, but the diversification offered by commercial real estate is still something that there are a lot of investors looking at, both private and institutional, as well as the inflation resistance of the property type. So there's still a great argument for commercial real estate, but getting that valuation to pencil just right is hard. The rate increases have, they're going to force the market to adapt a little bit, and that's going to take some time. There are still hurdles ahead of us. But in general, when you start thinking longer term going into 27, 28, and you look at the fundamentals for most property types, they look sound, they look like they're going to be healthy, and that's a good argument for the investment into the space. The question is, can you get the math to work today? So that's kind of how I see the pieces fitting together at this moment, but it's always fluid. This year is challenging.
Anybody have any further thoughts on that, or any different thoughts on that? So, Scott, the bidder pools have generally become shallower currently. When do you see the volume of CRE investment picking up?
Well, I think there's a wave of it. It depends on the sector, generally, but I think going back to the conversation we're having on interest rates versus real estate, there's a bid-ask spread in the marketplace, right? A lot of sellers are basically anchored to peak pricing. Buyers sort of can't make sense of where those cap rates often are relative to interest rates, and so that's led to a shallower bidder pool. At the same time, real estate allocations have faced competition from data centers, as a lot of these groups are now real assets, making decisions as a real assets group, which includes infrastructure, and also private credit. Private credit is getting a lot of the flows these days. And so I think that the bidder pool is probably going to remain shallow until, and it has recovered. Transaction volumes are up off their lows, but they're certainly sort of at or below their long-term average generally. And I think we don't anticipate sort of a wave of that changing until something changes. And I think the real estate's at the heart of a pretty simple business. It's a cash flow stream with a cap rate. I don't think we're going to, as I said before, I don't think we're going to get a lot of help on the cap rate front from interest rates. And so what probably ultimately needs to happen is rent growth acceleration. And that is the silver lining, or the other side of the coin, in terms of the narrative I laid out as it relates to all this spending and growth and, frankly, inflation. What it's doing, it's creating an increase in replacement cost, and higher interest rates have also shut off supply. Now, that does take a while to work through. I think it maybe, as John or Matthew mentioned, there's an overhang still in the apartment industrial market, and I think we've probably underestimated how long it takes to really kind of work through that oversupply that's hit the market, particularly because you've got to work through the first wave, which includes concessions, which then sort of follow on to the next leasing cycle. But if you play this out, basically, we'll be in a situation in the next, few years where you'll have, very, very little supply. Demand will continue to push down vacancy, and replacement costs are suddenly much, much higher. Now, in that scenario, that's a very positive scenario for rent growth and NOI appreciation. And I think, but until that story is more clear, I think we stay in this situation of a shallower bidder pool with a bid-ask spread. Now, what I would say, and from our seat, is that where the opportunity really is as a real estate investor is on the credit side. There's a huge opportunity to really solve that bid-ask spread by coming in as a subordinate lender, particularly as the regional banks and others have pulled back from the marketplace, and frankly, get access to some of this private credit money that is still being allocated generally through real estate credit. And real estate credit has gotten a lift because of what's been happening with private credit generally, and a lot of the software uncertainty around AI. So that's one area where I think if you look at where the risk-adjusted returns are really attractive relative to other asset classes, it is in that credit space, because borrowers will take your money at a pretty high cost of capital so that they can basically buy an option on a better capital market in which to have a liquidity event or exit, in a nutshell. And so that's one area that that we're very focused on.
Matt, what are your thoughts on that with the leasing fundamentals and how they're likely to contribute, or when they're likely to contribute?
They're very look. It's very bifurcated. If we look at the different asset classes, most major office markets pre-COVID were at their peak, call it 10 to 15% vacant. Most major office markets today are between 25 and 35% vacant. So you're still dealing with a large amount of vacancy. There's a lot of activity. We talked about the fundamentals improving, albeit slowly, but it's really in a certain segment of the market. Same thing is happening with industrial. You had these low single-digit vacancies in some of the largest industrial markets. A lot of those markets are still 10 to 15% vacant today. So I think as this continues to play out with those two asset classes in particular, you're going to continue to see a reshuffling of existing NOI that's in markets to the higher quality assets. So if we think about office markets, as the Class A market continues to get absorbed, there needs to be more stock. Scott mentioned there hasn't been much development of Class A the last 5 years. So who's going to capture that demand as that primo Class A space gets leased up? Same thing for industrial. We haven't talked about this. We touched on AI, but look, automation and power to run manufacturing and distribution and all that technology that's coming into your tenant that uses industrial space, that's also evolving very quickly. And you need new stock, modern stock to absorb that demand. So again, reshuffling out of older buildings into newer stock. So I think there's some positive movement, but I think as the Class A trophy assets continue to get absorbed, the question I have is, as Lisa mentioned, there's all this distress. Who's going to come in and invest and put the capital in to upgrade these facilities to meet the demand? We haven't seen a huge volume of new development. It's starting in major cities with office. It's starting in your industrial markets. But so there's going to be this time without new product on the market where there's going to need to be some demand, and those that make investments in some of these distressed assets, invest the capital, improve them to try to grab that demand. There'll be some good opportunity and some winners. So overall, I think NOI will continue to improve, but we still have a long way to go to get back to levels of what we all might consider a strong market.
John, you had some thoughts, I think, on NOI growth too, and what kind of
You know,
opportunity there is out there.
and I kind of want to reach back to the Scott's comments on the bidder pools, and it ties into that NOI growth. It's very hit and miss. It's very localized, right? Each market, each property type, each street corner can be very different from the next. And so, we've sold assets where we have very deep bidder pools, 20, 30, 40 real bids on assets. But that's the exception, not the norm right now. And when you look at the NOI growth, you can look at different markets for different property types and different assets. You're going to have really good income growth on a specific property where there's been some value creation. The investors have gone in, they've revitalized the property, they've brought in new tenants, and they're doing very well. I was looking at some apartment markets, and you have extremes. You have Sunbelt markets where you have negative rent growth, and you have markets like the upper Midwest where you're getting 6, 7%. And the same is true for most other property types, depending on that specific asset. And so it's a really challenging time because it's hard to make a blanket statement about what's going on with the market in the US or even in a metro when you have one property that could be doing very well because the investor has gone in with a strategy and a plan and been able to execute it very effectively. We've seen this with some office properties recently that have done very, very well, pushing 90, 95% occupancy rates and really strong rent growth. At the same time, the building across the street is virtually empty and probably going to trade for pennies on the dollar. So you're looking at this huge, huge range. And so investors really need to be dialed in and look at that property and have a plan for taking it forward. So for NOI growth specifically, it's going to be challenging. It's still challenging. I think Matt nailed it right on the head, but that's an aggregate. On a property by property basis, when you get down to that individual asset, there are still opportunities, but investors need to know what they're doing. They need to be, have strong operations and have the relationships to make that work.
Suzann, I would just add to that the herd mentality of how occupiers have historically executed leasing strategies, that's no longer consistent. So any investor really needs to get into the priorities of that business, understanding how they're making decisions, how they're thinking about near-term, long-term investment, what their growth strategy is, how technology, AI are going to impact their business. That level of detail is so much more important. You just can't subscribe to, well, this is a law firm or a bank or a tech company that's growing. This is how they scale. This is how they operate. All that is being assessed. Now, the good news is these companies have fortified how they're going to operate. We've seen it in the data. They're committing long-term. They're investing capital. They are signing leases. But I think a smart investor is really going to understand the tenant pool that's in a submarket or on a city block or how a city is operating. That level of detail is more important than ever right now if you're thinking about long-term NOI.
Mark, what's your read on how corporations are thinking? Do you see any continuation of a herd mentality, or are you also seeing a lot of more individual thinking?
I'm not sure I understand the question, Suzann.
Just wondering, sort of on a broader, not real estate specific, but on a broader front, how corporations are acting and making decisions. I don't know if you have any observations on that. I know, sort of putting you on the spot.
I think that I've heard the word bifurcated, I think maybe 3 times, maybe 4. I don't know. I'm going to use it again. Bifurcated. It really depends. I mean, it's depends on which part of the economic elephant you touch. I mean, if you're anything related to AI, you're going skyward. It's stratospheric. Some pick up in some strength in the healthcare industry that goes to strong underlying demographic demand. By the way, just as a factoid, because I am from Philadelphia and a Philadelphia native, it's the strongest growing large metropolitan area in the country right now in terms of jobs, and that's because of the healthcare sector. It's the largest in the country. But then if you go to other parts of the economy, it's a real struggle. Other industries, we're talking about commercial real estate. I consider that to be a bit of a struggle. Housing is really on its back heels, single family housing in particular. So it really does depend on, which part of the economy you're looking at. And you can see that in the consumer too. I mean, if you're well-to-do and if you own stocks, and you're fortunate enough to own AI stocks, and if you're just indexing, you're doing pretty well. Your finances are in good shape. You're out spending and traveling, and things are good. If you're a middle income, lower income American that own very little in stocks, and of course, if you're lower income, you don't even own your own home. It's a real struggle, particularly in this higher rate environment, which we've all been talking about, which it looks like it's going to be higher for quite some time. So it's not only businesses that are struggling and CRE struggling with higher rates, it's individuals because they're paying 20% on their credit card. Home equity lines of credit are much more expensive. You're a small business owner and have a bank line with it's tied to the prime rate, you're paying more. So, I think it's just a very, I'll use the word again, bifurcated situation, and that's why it goes back to that pitch battle I was talking about before between deglobalization and AI, depending on whether you're in that headwind or tailwind, it makes all the difference in the world. So really big differences across the economy.
Thank you.
Did that answer the question?
Yes, thank you
did.
for
Okay.
giving us
All
that
right.
perspective.
Yeah.
Yeah. And we are going to Q&A in just a few moments. So if anybody has any questions in the audience, I know some of you did submit them in advance, and we've got plenty to draw from. But if anything has occurred to you during this discussion, please don't hesitate to put it in that Q&A field. And I am thinking that I'm going to go around and ask everybody one final question before I go to Q&A, because I know that it'll take a few minutes to get around to everybody. So Mark, since you were just talking, why don't I start with you and ask you, just continuing on from there, what issues or concerns do you think we should watch out for in the coming months?
Well, listening to the group, I think we need to be worried about interest rates. Obviously we talked a lot about the Federal Reserve, and I think the most likely scenario is the Fed stays on hold for a while. I'm not think inflation's a problem, but it's going to come in as energy prices come in, assuming the Iran war continues to wind down. And we still have a soft economy. I think the labor market is still soft. So I think ultimately this all goes to a draw and the Fed stays on hold. But I worry about long-term interest rates, that there might be a spike in long-term rates, because of some of the things that Scott was talking about. Our fiscal situation is, I've been following that for 35 years, and it's about as ugly as I've ever seen it. And the trend lines there don't look really very good. And there's a lot of things in the plumbing in the Treasury market that make me nervous. Primary dealers just haven't expanded their balance sheets and be consistent with the amount of debt outstanding. So the trading is kind of sloppy, and there's a lot of volatility, which is only going to get worse because the Warsh Fed is going to be much less transparent, and that's going to make create a lot more volatility in markets. And then if you look at who owns the Treasury bonds, that's shifted away from price insensitive holders like the Fed or institutional investors globally, or even the banks, to hedge funds that are obviously very price sensitive and play a leverage basis trade. So I can go on, and going back to the deglobalization that's going on, that means we're pulling away from the world's pulling away from us as fast as possible. That means the U.S. financial system is going to be less central going forward. Not that we lose our reserve currency status, that's not in my lifetime, but we lose the safe haven status. So you mix all those things together, and I'd say thing I'd watch out for. It's not my baseline. It's not, in that kind of sanguine outlook I began with, but I'd be on the guard for that. I think there's a real potential for interest rates to jump, in a very significant way at some point in this horizon that we're talking about. Sorry, you didn't. I should have. Maybe I could giving you a positive surprise. I gave you a negative surprise.
Oh, well, we need to think about all realistic concerns. So,
There you go.
John, what are your thoughts? What are you concerned about? And are there any bright spots you see ahead for commercial real estate?
You know, I'm with Mark in that the interest rate risk is high. And I think the uncertainty is really the biggest headwind. I think people are more cautious. I think that they're waiting for another shoe to drop. We had tariffs changes, we had immigration policy changes, and all of these affect the economy. Then we have the war in Iran and the impact that we've seen on inflation and the pullback in the positive outlook on rates. And all of these things weigh down the decision-making process. And it's hard to look past what's going to happen, with rates today or tomorrow or next week or 3 months from now. But on the other side of the equation, when I'm looking further forward, when I'm looking forward, 2, 3, 4, 5 years, things start to look much more interesting. You look at the demand for office and it strengthens slowly, but I think over a longer span, you see a material change. When you look at retail, nobody's building retail. And we have those vacancy rates right around 5%. You're seeing positive rent growth. You see that momentum is there. Yes, you have to be careful, pick the right asset in the right market, but there are still those opportunities. And I think the tide will lift those boats over the longer term. And it carries over into industrial as well. We overdeveloped industrial, but the absorption is still positive. And when you look at e-commerce growth, it continues to be sustained and strong. We have, Prime Day today and everybody's got a big sale. So I think e-commerce as a percentage of retail continues to grow. So housing demand, same thing. We still have long-term positive drivers. I think the inflation resistance of the asset class is relatively strong. I think as a diversification strategy, we saw the NASDAQ drop today, and investors should be looking at how do I balance that risk? Yes, the stock market's done very well, but is it getting a little top heavy? And I think that the diversification and the advantages of commercial real estate become even more apparent over the next few years. And I think it's a real opportunity for investors that we're in currently. The rates are going to be a headwind, but I do believe that the long-term drivers are positive for the commercial real estate market.
Okay, thank you. I do want to make sure we have time for audience questions. But I also want to give the rest of you a chance to weigh in here. So maybe we'll just really briefly, if there's anything you'd like to add, and Lisa, I can ask you first.
Sure. I know, what's top of mind for me is that we have significant amounts and volume of maturities in 26, 27, and 28. The highest being this year at about 875 billion. The problem there is a lot of these loans that are coming due have much lower coupons, mortgage rates than what we can provide to them today, somewhere in the order of a couple hundred basis points. So it's significant. And you apply that also then to a cap rate, the picture gets a little dimmer. So we are concerned about today's elevated benchmark rates that obviously affect cap rates, affect mortgage rates. And so, what's going to happen with some of these assets? And some of the biggest, in terms of where we see the maturities, 875 billion, 396 of that is from the banks. And the next highest is CMBS at around 200 billion. So some of these loans will get extended for some period of time, but that can't go on forever. I am concerned of what happens at that point. If rates stay as elevated as they are today, cap rates, mortgage rates are not conducive to positive things at that point. So not to sound like Debbie Downer, but to the extent that some of these assets are performing generally well, our delinquency rates are kind of high. If you think about what's driving it, the office market is at an 11.5% delinquency rate right now. The lowest is industrial at just 1.3% in terms of performance. And the rest of it tends to be in that 6 to 7% range. So the 7.6% altogether across these assets, is not necessarily what you'd like to see. And so in an environment where, regardless of the distress of whatever's going on at the asset level, now you're going to have, still kind of elevated rates that are going to impact, as I said, both cap rates and thus valuations, and certainly the ability to refinance those loans at an elevated mortgage rate. Sorry,
Okay.
that sounded like Debbie Downer.
Scott, Matt, anything to add?
Well, it's a great time to be a lender, right?
Or
What
not.
Lisa just described. Well, it depends. It's a great time to be a new lender, a new vintage lender,
Yeah.
because what Lisa just describes a huge demand supply imbalance in the capital markets, and so I think that's a huge opportunity. Look, ultimately, there's a lot going on to be excited about. How we implement AI into our businesses. The fact that we do have strong economic growth and a huge creation of wealth, that's occurred on the back of that. And I think also it's been touched on, but real estate actually is one of the advantages it has is valuations never went up that much to begin with, so it's actually well positioned from a relative value standpoint. And in addition, it's positioned to be a good inflation hedge in a strong economic growth environment, because it hasn't repriced up a lot. You've got supply coming down, and you are already seeing the beginnings of strong NOI growth. So that would be my sort of positive view of what's going on.
Thanks for the offset. That's good.
Suzann, I'll keep it short. I know we want to get to Q&A, but and we talked a lot about the interest rate environment as it relates to investing in commercial real estate and a lot of the workouts that hopefully will take place here, Lisa. But I think about it from the corporate point of view. Scott touched on this somewhat too. Many of these corporations operate on debt, and higher for longer impacts their operating margins. And so I think if we want to continue the growth that we've seen and longer term, an ability to think longer term, it would be nice to get through what we think will be a modest level of inflation coming with the interest rates. I would also say the growth that AI will bring, on a positive note, I think it's going to be substantial. I think we focused a lot about job replacement. I actually think it's going to push top line for most corporates in ways we actually haven't really seen yet, and it's only going to get faster. So that's exciting to me. That also makes me just think about the labor pool in general, and the labor pool needing to catch up with how this technology works so they can actually use it in their jobs. And I think a lot of that's in play right now, and will end up being very positive for our sector at the end of the day.
Well, we actually did have a question from the audience about hiring needs in the second half of 26, wondering which asset types will have the highest hiring needs: retail, industrial, multifamily, or data centers. Anybody have an opinion on that?
Hiring?
Yeah, higher. I think the data centers will definitely, from a percentage point of view, are going to see most of, those are all new jobs, right? Those the hyperscalers are continuing to scale. I would say at scale, look, AI should add new jobs to all of those sectors. I think how people work traditionally is being augmented right now, and that will need to play out. But there isn't an administrative or analytical job that isn't using AI today, and that will continue to improve. And I think AI will drive new jobs, and it will augment others in ways where they'll have to work differently. But I don't think anybody has a succinct answer. This technology is too new. It's too transformative. We haven't seen it play out, and all of us could pontificate about what it could be. But bottom line is, we thought differently about it 30 days ago than we do now, and we'll think differently about it in 30 days again. The change is fast, and it will only get faster. So hard to predict, but I think Mark covered it at the top. The economy has seen growth from AI, and that will continue, and that should be good for jobs.
Okay. I have a question. Equity capital is re-entering the market, but with a sharp focus on downside protection and lower leverage. How does debt capital respond?
Well, I think that's where I see the opportunity because, what's happened is traditional lenders, due to regulation, risk aversion, debt service coverage ratios, are all driving lower proceeds on refinancings, right? You just said simply, you can't get the same loan you could get at the beginning of this decade if you refinance today. And it's another way of saying what Lisa's been saying on this call. So the opportunity is there's a gap in capital stacks. So, as which is closer to equity, is a hybrid of equity and debt, preferred equity lending, mezzanine lending, that a lot of the banks won't lend at, or I don't feel comfortable being at those leverage points, where borrowers you can originate loans at, 10 to 15% types of IRR as a result of the fact that there is this supply demand imbalance in capital markets with all this debt coming due, and not a lot of reduced amount of traditional lending available. So I think that's the key here, and we're probably halfway through this sort of rolling reset to these higher levels of financing that Lisa keeps talking about. We've got to get through this wave of loans where transaction volumes really spiked at the beginning of this decade when they cut interest rates to close to zero. That's all needs to roll off, and we have to get through that. So I think that's actually one of the bigger opportunities that we see as a real estate investor right now.
And if I could just add there, just to add some numbers to that, in 26, 875 billion in loans are coming due. And those are all loans that are going to have that sort of significant delta between where those loans were made and where they're going. And that could be 300 basis points. And so to the extent that the asset is performing well, chances are that will work. But if there's any kind of trouble there, it's going to make it that much more challenging. The numbers declined to around 600 billion in 28. Still a lot. And it's all done, as I said, the delta between where these loans are and where they're going is significant. That could change, and that's what we're hoping certainly will happen between now and the next couple of years when most of these loans come due. Like I said, in 28, it does decline to about 600 billion, still a lot, and still with that, sort of significant delta between where it is and where it's going. Again, I wish I had something more positive to say.
I think the banks are stepping in a little bit stronger, and I think the prospect of deregulation and changes on their capital reserves, which looks increasingly likely, could bring more liquidity to the debt markets, and I think that could give some relief. Mortgage Bank Association saying, we're going to do $830 billion of loans, including refi and transaction this year, which would be up 18% from last year. So I think that there's potential for a lot of lending to take place.
Mm-hmm.
I think there will be some properties that are going to face delinquency or challenges, or they can't get the financing, or their cash in refi is too expensive or whatever. But I think that we start to see some of the clearing of the market that we've been waiting for.
And one last question, kind of a bigger, broader question that a little bit has been touched on, but what does a Kevin Warsh Fed mean for CRE? Kind of the bigger picture of it. Anyone want
I look at Mark.
Anyone?
Come on, Mr.
You know the guy. Come on.
Well, I think the most likely or a very likely change in the way monetary policy is conducted is around transparency. So from Bernanke to Yellen to Powell, the Fed increasingly increased the transparency of its decision-making process. We knew exactly what the reaction function is, what variables are looking at, how they're weighted. There's a lot of guesswork involved, but we had we couldn't have asked for more information about how policy was being conducted, and they did their very best to kind of guide the market forward, and that reduced volatility in markets to a very significant degree, which I think is critical to risk-taking, interest rates, lending, equity valuations. And that's where I'm most concerned, that we are going to, that the Warsh Fed is going to be much less transparent. You could see it in the meeting last week, right? I mean, the statement with the meeting said literally nothing except that interest rates are at 3.5 to 3.75%. And Kevin, Chair Warsh, didn't participate in the dot plot, which was the one thing we all looked at because it's the only thing we could look at. So markets are going to fill in the blanks. That's what they're going to do, and that means they're going to be all over the place. So the one implication that I can state with a high degree of confidence is that we're going to be you're going to have to pay me a lot more money, Suzann, to tell you what the Fed's going to do. And markets are going to be trying to figure it out. It's just going to create, I think it's going to be counterproductive at the end of the day. I wish I could have been answered in a more positive way. Sorry, like Lisa, but I think there's other things that the Warsh Fed will do, but unclear whether they get anywhere. So he's talked about, different inflation measures, about investing in data, about reducing the balance sheet, forming task force to consider all those things. That's great. I'm all on board, but I don't really think that that's going to go anywhere, positive or negative. I think that's going to stay on. We're going to get a task force report. It's going to stay on the shelf. There might be some tweaks, but at the end of the day, the one thing that we can really count on happening is the Fed's going to become less transparent going forward. And then we have the debate as whether that's good or bad. In my humble opinion, I think that's moving in the wrong direction.
Okay. Well, why don't we end on that note? Because unfortunately, we are out of time. If we didn't get to your question today, we will certainly try to cover them in future webinars and future written coverage. So please keep an eye out on our website and on our emails and newsletters for that. We will be sending everyone a link when the recording is available. And if you enjoyed today's session, we hope you'll be able to join us for our fall CPE Voices webinar, 10 Ways Your Business Can Save Money on Operations Now. Also, if you'd like some further perspective, more in-depth perspective on the outlook for multifamily, be sure to register for our MHN Voices webinar that's taking place next month. I would like to thank our speakers once again for a very interesting discussion, and thank you all for joining us today.
Thank you, Suzann.
Thanks,
everyone.
Suzann. Thanks, everyone.
Take care.